You think I won't? You think I won't do this in 10 minutes?
He never knew when to quit.
All right, we're gonna be talking about how I invested $400,000 into the US government. What a positive spin, AKA how I just lost $400,000 to the US government via taxes. Taxes, Steve! Good answer!
Texas, Steve. Texas. Texas.
It turns out that when you make $2 million a year, you have to pay taxes on said $2 million. We'll get to that in a second, but first I want to provide a little bit of context for those of you that are new to the channel. So in April of 2021, so roughly 16 months ago or so, I quit my full-time job. I was working as a full-time copywriter at an ad agency, and I was making $110,000 a year. Lots of things happened in my financial and entrepreneurial journey from April 2021 to December 2021. Spoiler alert, my income exploded, and I actually ended 2021 having made a total of $2 million. So let me be honest here, I was not prepared for this, and I don't know how anybody could be prepared to basically, 19x, 20x their income in the matter of 6 months after quitting their full-time job. It's been a little bit of a mind if you will. Yeah, I was not prepared for the lessons that I would be taught the hard way, and I quickly started to realize that making money is kind of useless if you're giving it all to Uncle Sam out of the goodness of your heart, aka being coerced because taxation is theft.
Uncle Sam put your name at the top of his list.
I don't know, I'm just kidding, I don't really believe that. But, because you gotta kind of think of making money two ways. There's making money where you work for it, right? Whether it's passively or actively. And there's also what you give your money to, taxes being one of them. So if you can figure out how to evade taxes, legally of course, and not pay them, then that's money that goes back into your pocket, meaning from a conceptual level, it's money that you're making, because it's not leaving your pocket to go to Uncle Sam. So I have spent the last 15, 16 months truly nerding out over taxes, like really studying it as much as I possibly can. And that's what I'm gonna be talking about today. See, the thing is, most people think that taxes are boring, but I think that if you're money-minded and you are trying to sprint towards wealth, then it's the opposite. It's not boring, it's actually a game. And it's a game that I've gotten pretty damn good at.
So that is why I am better than everyone in the world.
But not good enough, because I still paid $400,000 in taxes because I just didn't have enough time to plan and implement all the strategies out there. But I was able to get away with 5 very specific things that slashed my tax bill big time. We're gonna be talking about them today. And my favorite strategy out of all of these is number 5, because it actually allowed me to spend money on myself, which I never do.
Clothes.
Treat yourself.
Fragrances.
Treat yourself.
Massages.
Treat yourself.
Mimosas.
Treat yourself.
Fine leather goods.
Treat yourself.
It's the best day of the year.
The best day of the year!
So you're gonna wanna stick around until the end. First, let's recap how this all shook out. I wanna give you some more specific numbers so you kinda understand how everything fell into place. So for 2021, my gross income, I don't have it memorized, I'm just gonna look here, was $2,023,555. Now, I'm sure you heard the trope that millionaires don't make their money from one source of income, but 7 to 8, and that was the case for me. So this $2,023,000 figure, we'll call it, was made up of consulting back when I was still doing that, W-2 income, because remember, I was working a full-time job in the first 4 or 5 months of 2021, affiliates, Airbnb income, YouTube income, and the educational programs that I launched, like Lamp Camp and Host Camp. Shout out to all my campers out there. If you're one of the OGs, please leave me a comment down below. And I'm not gonna talk you through all my write-offs specifically, but let's just say that after all of my write-offs, deductions, expenses, all that kind of stuff, my net was roughly $1.25 million. So remember, gross income, $2,023,555. After I sliced and diced all my deductions and everything, I was at $1.25 million. So I was able to nix roughly $750,000 off my top line. Now, how did these taxes actually break down? I had my federal taxes, which were $317,000. I had a set of state taxes for my S Corp, and those came out to $84,000. And then I had another set of state taxes that came out to roughly $1,900. Now, this was a huge surprise to me because I just didn't know too much, but I thought living in Tennessee, I was gonna pay no state income tax, which is technically true, but I did have to pay a corporate tax, and that corporate tax came out to $84,000. So that was a final little juicy last minute surprise that I was like, oh, I owe another $85,000. I thought I wasn't gonna owe anything in Tennessee, but that's not really how it works. And weirdly enough, that $1,900 tax bill was in California, and it was by far my smallest, and I was expecting it to be a lot more. So when you add all that up, it comes out to a little bit more than $400,000. I think it comes out to, I'm I'm not gonna pretend like I know how to do this. Roughly $402,900. Oh, that's actually pretty close. Actually closer than I thought. So now I wanna talk about the 5 tax loopholes, not really, they're all perfectly legal and totally in the code, that I took to slash my tax bill. Because it actually would have been a lot more than $400,000 had I not done these 5 things. So let's start with number 1 here, and that's this beautiful, beautiful, beautiful thing called bonus depreciation. You can read up on this. It's called Section 179 of the tax code, but it effectively lets me write off the entire cost of machinery or vehicles that weigh more than 6,000 pounds. Now, I document all the ins and outs of Section 179 as it pertained to my specific situation a couple of months ago in a video about my Audi e-tron, which is a $125,000, $134,000 car, something like that. And I talked about how I got half off of that vehicle through all the different tax codes and write-offs and everything. So go check that out if you want to learn more about it. But let me just illustrate this as clearly as I can. I bought 2 vehicles and they were both electric cars, and because they were both electric cars, they had heavy batteries in it, and they both weighed over 6,000 pounds GVWR, gross vehicle weight rating, something like that. And because of that, that qualified. Now, if I had $1 million of income, I would be taxed at the 37% rate. So let's just math that out really fast. $370,000, pretty easy. I guess I could have done that in my head. However, because I bought those 2 vehicles, I'm able to subtract that from my gross income. So that would bring it down to $800,000. And then I would then be taxed 37% on that $800,000, which would come out to $296,000. So instead of paying $370,000 without the vehicles, I was able to buy those vehicles, slash it from my income, and pay $296,000. Now remember, I'm not a CPA, so go talk to your CPA and actually get advice from them. I'm just talking about how this worked in my personal situation, not advice. So a couple of ways to look at this is that I effectively saved 370 minus 296, $74,000 in taxes because I bought these vehicles. So if you subtract $74,000 from $200,000, it's like I bought both of those vehicles for $126,000. Hopefully you're tracking with me on that. There are a bunch of caveats here. I still bought the cars, right? Like there's still an expense that I have to pay for. It's not like the cars are free, and it's not like you should go buy cars if you don't need them, right? It's a wasted expense if you already have cars. But I needed cars for my businesses, so I thought, why not? Especially if I could get them for, effectively half off. But there are a couple things you have to keep in mind. If you buy them as business vehicles, you have to use them for business. Otherwise, you have to break that percentage down from personal to business, and you can only write off the business side of it. However, if you buy it at the very end of the year, like I did on the very last day, and you use it 100% for business, you can write off 100%. And then in the next year, you just have to maintain a 50-50 split between personal and business. And also, don't think you can just get really smart, write it off, and then sell it, and then buy another car. You will get hit with the recapture tax if you sell it too soon. I don't know what y'all are seeing. Hopefully that was a very edited down, concise version of what I just said, but hopefully that makes sense. All in all, this tax strategy saved me about $74,000 off of my taxes. If you have any questions, leave them in the comments down below, and I'll have my CPA, Matt Bontrager from TrueBooks, answer them for the first hour after I post this video. Hopefully he agrees to that. He probably will because he's awesome. Number 2 is this beautiful, by the way, every single tip in this video is gonna be very beautiful, but it's a beautiful thing we like to call cost segregation. So typically whenever you own real estate, you can depreciate your investments by 27.5 years. If it's a commercial property / a short-term rental, then you can depreciate it over 39 years, meaning every time you do your taxes, you do a straight line depreciation, which ultimately saves you money on your taxes. Now with cost segregations, you can actually accelerate all that depreciation in a year. I was able to do this with 3 of my properties and take $418,315 off of my incomes. I basically took a loss. I always do quotes here because it is taking a loss on my properties. Even though I made money on the cash flow, I can take the depreciation, apply that to my income, and it looks on paper like I took a loss. So let's just say that my cash flow was $100,000, but my accelerated depreciation was $418,000. Then on paper, it looks like I took a negative $318,000 loss. But if you multiply that $418,315 figure by my tax rate of 37%, then it actually saved me $154,776 off my taxes. And here's a really cool part. The cost segregation reports that I paid for only cost me $1,500. So for $1,500, I was able to 1,000x my return and save $154,000 on my taxes, which is awesome. I'm actually working on launching something in this vein so that I can release it to my audience and you can use it to save 6 figures on your taxes. So stay tuned because it's gonna be totally awesome. Now, lots of caveats here, but this is the last time that you can take 100% bonus depreciation in the first year. Next year, that's gonna go down to 80%. And then after that, less, and then after that, less, and after that, less. it. So every single year after this year, this benefit's gonna get less and less beneficial. And same thing with cars. You're only gonna be able to take 80% depreciation on those as well. So if you are like trying to save money on your taxes, this is gonna be the year to fully utilize cost segregation and bonus depreciation for cars. To fully utilize this and just really destroy your tax bill, you need to be a real estate professional. We're not gonna talk about that now in this video, but you can talk to your CPA or my CPA, Matt Bontrager. If you wanna book a call with TrueBooks, they're friends with the brand. I'll leave a link in the description down below. Actually, I'm gonna have Matt react to this really fast and just make sure I didn't drop the ball anywhere. All right, Matt, did I totally butcher this or am I on the right track?
You're totally on the right track here. So the one thing I want to call out is there's a little bit of a difference between needing to be a real estate professional and taking bonus depreciation. First, bonus depreciation is great if you're going to buy a large asset like a vehicle, piece of equipment, piece of machinery for your business. This is the last year that you can take 100%. When Trump passed the Tax Cuts Jobs Act back in 2017, it increased it from 50% to 100%. It is set to lower to 80% next year. So not the end of the world, but it is a big hit. So 2022 is definitely the year to buy your large assets before the year ends, so you can maximize the amount of depreciation you get. Now, being a real estate professional is very important when you're trying to take depreciation on real estate. So let's say you're an investor and a landlord and you own property. It is a great way to take huge losses by taking big depreciation expenses. But to do that, it's easier if you can qualify as a real estate professional. So if you're going to buy equipment and cars and laptops and things like that, you do not need to be a real estate professional to take depreciation. But if you're going into the real estate game, being a real estate professional is going to set you up for some big tax savings.
I've actually had Matt give live seminars to my host campers and just divulge the in-depth, juicy tax secrets out there for saving money and taxes in your Airbnb. So if you want to learn some of those nitty-gritty tax things as they pertain to your Airbnb business, or how to start an Airbnb business, how to run it, how to operate it, how to design it, how to automate it, we teach you all that and more in Host Camp, my 12-month mentorship program. And if you want to find out if my program is right for you, you can head over to hostcamp.com to book a free call with my team. Tip number 3, crypto loss harvesting. All right, so basically, this is if you buy crypto at a high and then it goes down in value, you can sell it at a loss. Then you can rebuy it at the same price that you sold it for, but take that loss and report it on your taxes. So this one is really good. I couldn't really use it too much. I wasn't able to fully utilize it in 2021, but let's just say in 2022, Daddy's gonna be taking about $200,000-$300,000 in losses from his crypto. All right, so let me just illustrate this for you really quick. Let's say that you're like your old friend Rob here and you have about $400,000 in crypto.
I'm just living the dream.
And let's just say that said crypto dips 66%. To keep it easy, we'll just say it dips 50%, right? So your $400,000 investment is now worth $200,000. So I can quite literally sell that crypto, take a $200,000 loss on paper, rebuy it for $200,000, then take that $200,000 loss and take it off of my income. So if I make $1 million and then I take a $200,000 loss in crypto, I have now made $800,000 on paper. Now you can kind of start to see how this all compounds, right? Because I took a $200,000 deduction for my cars, then I can take a $200,000 loss on my crypto, and then I can take my cost segregation, which is a $418,000 loss. And right there, that's $818,000 of losses that I can take off of a $1 million income that would then leave you with a net income of like 200,000 bucks, right? So you can start to see the more of these tax strategies that you start stacking, the more money it can save you in taxes. Now, crypto's all very new, and I gotta say that the crypto loss harvesting, a lot of people they don't think it's gonna be around much longer. So I'd imagine 2022 is the last year, if not one of the last years, that you can pull this little maneuver. But again, 2022 is a perfect time to do this because all crypto is down. So a couple downsides here. Obviously, if you sell $200,000 of crypto, and you buy it all back, it's gonna cost you a lot of money and fees to do that, but that'll more than likely pale in comparison to the actual tax savings that you're gonna have. There are also plenty of tools out there that you can use to help you calculate all this. I don't know enough about them, I can't endorse them, and I will also say that you can actually technically do this with stocks, but there are certain laws and rules in place with stocks that I believe off the top of my head say that you cannot rebuy a stock after you sell it and take a loss for 30 days, which then becomes a lot riskier because if you have to wait 30 days, there's always a chance that that stock could shoot up dramatically. All right, number 4 before I became an S Corp. My CPA advised this and said that effectively when you're self-employed and you're making $40,000 a year, it makes sense to incorporate and become an employee of your S Corp, so that's what I did. Actually, me and my wife both became employees of my S Corp. And so because of this, we're actually able to set up a company match as well and max that out. So to keep this very simple, let's just say that you make $100,000 and you choose to max out your 401k at $19,500. You can do that tax-free. So to the government and the IRS's eyes, it looks like you're actually making roughly $81,500, not the $100,000. Now we're both able to do this, and then our company matches a really large portion of it, and it's a happy day for everybody. That's all I'm going to talk about with S Corps, because admittedly I don't know that much more than what I just described to you.
All right, then, keep your secrets.
But maybe Matt can provide a little bit of clarity on this one.
Yes, the S Corporation is a great strategy to use. What you're doing when you change your business to an S Corp is basically telling the IRS that you want your LLC that you have to be treated as an S Corporation. The main reason we like to focus on the S Corp is to lower self-employment tax. Self-employment tax is about 15%. When you're a W-2 employee and you work for a big business, they pay 7.5%, you pay 7.5%. So when you're self-employed, you are both the business and the employee, and you pay the entire 15%. So the goal with the S Corp is to bring down the amount of that self-employment tax. And by doing this, we do exactly what Rob said, which is place you on payroll. So you are now an employee of your business. The benchmark to become an S Corporation is about $50,000 net income. So when your business is approaching that benchmark, it's time to talk to your CPA about it.
Tip number 5, spend more money. What? Spend more money? You're gonna save in taxes? That's right. Let's just say that I went on a huge shopping spree in December for things that I really needed for my business. So when you're running a business, all necessary expenses that you need to run said business can basically function as write-offs. So if I have a YouTube channel, I can buy cameras and microphones and studio lights and studio equipment in general and write all of that off on my taxes. So if I make $100,000 and in December I went on a shopping spree and I was like, oh my God, I need to spend money or else I'm gonna pay a bunch of money in taxes, and I spent about $30,000. I bought like things like cameras, lights, a MacBook Pro that still has not been opened on my counter. We bought a lot of stuff for the channel. Was it all 100% things that we needed to buy in that moment? No, but I didn't want to just spend all that money on taxes, so I figured I should buy things that I'm going to utilize in my business and try to just splurge in a way that's going to benefit my business, and that's basically what that came down to. So let me tell you, spending $30,000 in a month, pretty hard, did not like doing that, kind of felt guilty, but for me, when I was looking at it, literally anything I buy for my business comes at a 37% discount. Truly, when you think about how I'm taxed and how much I'm taxed, which is 37%, if I just buy something, it's a write-off, that saves me 37% on that income that I would have just kept in my bank account.
This is a great way and one of our biggest strategies when it comes to tax planning. If you have the cash flow and you are at a higher tax rate, let's say 37%, a great way to look at spending money in your business is to look at the after-tax cost. So for example, if I buy something for $100, but I'm going to be able to take a deduction for it and my tax rate is 37%, I'm effectively going to save $37 in tax by making this purchase. Now, to be clear, I'm never a fan of just spending money to spend money, but if your business could use whatever you're spending money on, whether it be equipment, advertising, more people, I'm all for spending money for the tax deduction, as long as it pushes your business forward. Great strategy here.
So you want to be really careful here, but there's a fine line, and this is my way of both rewarding myself and investing in my business. A couple of final lessons here. Thank God.
Hallelujah. Thank God.
I held on to a bunch of money in my bank account because I knew that my tax bill was going to be really high. I just kept that money close. I should have invested it, honestly, but I was just so scared because I was like, oh my God, I've never made this amount of money. I'm just going to keep it in a bank account. When tax season comes, I know it's going to hurt. And then whatever's left over, I'll just keep for myself. And that's kind of what I ended up doing. My plan for 2022 is to pay 0 in taxes. I'm working super hard on this by buying a ton of real estate. I bought a luxury property that was $3 million. I bought a hotel. I want to buy another hotel. I'm really actively working to buy more real estate. I have about 3 or 4 months to close on way more property that I can cost segregate and hopefully slice my tax bill completely away. TBD, but I will say that my income is probably going to be double what I made last year. So it's going to be a tall order. I am a little nervous about it, but again, I'm holding on to a lot of money for this exact reason. Tax planning and tax strategy is so important. You should be doing this very, very early on in the year. In October, you should have a general idea of what what your tax bill is going to be. That way you can plan for how to mitigate that tax bill and get it as close to zero as possible. This is stuff that they don't teach you in school. There's no wealth school that teaches you how to do all this, but it's true. You really need to plan taxes, not when you're doing them, but really at the beginning of the year, guys. I cannot stress that enough. And lastly, to all the people that are out there and going to say like,
how dare you not pay taxes? You're just, creating the gap in wealth and this and that.
Listen, I'm not saying that the tax code is right or it's perfect, but here's what I'm going to say. There are billionaires out there that are doing it every day. The tax code is written for real estate. It's written for the wealthy. It's written for millionaires and billionaires. Arguably, they abuse it. And I'm not going to just be this person that's like, well, I'm morally ethical and I'm going to choose to pay taxes because I'm a good citizen. No, I'm going to play this game that the billionaires are playing because why not? They're playing it. I've had this debate with friends, and then there are people on TikTok and YouTube comments that like try to make me feel bad. I'm like, no, dude, you should be playing the game too because you know what? They are, right? All right, that's it. That's my little soapbox. I don't even know if it made sense, but that's it. All right, have a good day. Don't forget to like and subscribe. Book a call with True Books if you want. If you want to learn how to start an Airbnb business, go to hostcamp.com, and we will see you on the next episode of Raw Bill. All right, bye.